Okay. So I think now is the time that we get started. Hello, everyone, and welcome to the session. This session, as opposed to what has been communicated to you, would be for 1 hour. And tomorrow we will have this session for 1 hour at the same time. So today we will be discussing about various applications of financial analytics. And affirmatively will get started with the basics of financial analytics. We will take the discussion further and we will understand a few, and then tomorrow I'll explain you the complete session of financial analytics. People who want to pursue their careers, we have devised this program bearing those kind of people in mind. Let's get started. Here is a quick tidbit for you all that the size of the devices are shrinking significantly and they are becoming more powerful. Data centers are becoming quantum computers, and quantum computing is the next big thing. You can just Google and you'll understand. The size of the devices are becoming smaller and more powerful. This is an indication of that. The number of transistors on a chip are getting doubled every year. It's written as every 2 years, but now today as we stand, the speed is increasing even further. The speed at which they are making these kind of chips powerful. Density of hard disk doubles. That means the amount of data that people are storing on the hard disk for the same size is increasing. What does that mean? That means if you have a specific hard disk of say this size, today if I assume 2 terabytes of data is getting stored on this size hard disk, then after 1 year from now, you can actually store 4 terabytes of data on the same hard disk. That's what is happening today as we stand. Then, network capacity. Data is getting double every 9 months using something called as optical fiber. And then the number of pixels per dollar in the digital camera is getting double. That means the quality of the images is increasing. As and how the quality of the images increase, people will start resorting to taking more and more images. That means image analytics would be at its 10th. That's pretty basic. And then you have artificial intelligence, data science, data mining, machine learning, deep learning. A lot of people keep asking me questions on what is the difference between or among these terms or terminologies. Let me just quickly demystify that. Artificial intelligence. Okay, just scribbling pad software. Okay. Artificial intelligence means automating human intelligence. Human intelligence through some computation. You use some computation and automate certain things. That's human intelligence. For example, humans will drive car, and when they drive car, you know for a fact that they are going to control a lot of things such as steering. They control the brakes. and they control the you know speed, accelerator, and many other things. And all these things are manually done by humans. Can I automate these things? Okay, is a question. And the answer is yes. And the result of automation is self-driving cars, autonomous vehicles, driverless cars. If you can automate whatever humans are doing, that's called as artificial intelligence. And data science is collection of bunch of techniques such as statistical analysis, data visualization, forecasting, and its collection of bunch of other techniques. And these techniques, when implemented, you can build artificial intelligence application. Within data science, you have something called as data mining. It's like I keep giving this example of coal mining. What do you do when you mine coal? You dig coal, and obviously you get coal. But if you can get diamonds, wouldn't you be happy? You'll be extremely happy, right? On similar lines, when you dig into the data, you'll get insights. And that insights, which will be like diamond, game changing for the organization, that is what your companies will be looking out for. And then you have machine learning. Usually the term machine learning is associated with predictive modeling, usually predictive modeling. But then it can also be associated with supervised, unsupervised learning and reinforcement learning. Supervised learning, unsupervised learning. And now the new field which has emerged is reinforcement learning. Why am I explaining these things? Because I'll touch upon a few of the interesting algorithms or use cases that would be part of financial analytics mainstream program. The mainstream financial analytics programs carries a lot of interesting algorithms, a lot of interesting use cases. Right? You will understand. And then you have deep learning. Deep learning is a special branch of machine learning, which is usually used to deal with unstructured data. You have unstructured data, like you have audio files, images, videos, textual data. When you want to deal with usually unstructured data, people use deep learning. Though people heavily use it on structured data also, the true benefits of deep learning are realized or uncovered when you deal with unstructured data. Okay, and this is synonymous to neural networks. Deep learning is synonymous to neural networks. And no matter what technique you apply, at the end of the day, what do? You end up building AI application. Right? This is how it works. Then a few quick insights for you all to motivate you to pursue financial analytics. But let me tell you upfront that people who would have completed their data science training or people who are already working as data scientists are eligible for financial analytics. This is something which will add as an additional value add to your existing profile. If you already have knowledge about data science, then this will be eligible. Okay. Recorded videos we will not be able to provide to anyone, and only those people who you know, enroll for our financial analytics program, only they will get the videos. We will otherwise not be in a position to share the recorded videos. Unfortunately, that's the policy. Okay. Financial jobs requiring AI skills increased by 60% last year. Who's saying? I'm not saying that. CNBC is saying. By 2030, 400,000 full-time jobs in capital markets, asset management or investment banking, brokerage, etc. These many jobs in these capital market streams will be lost because of technology and AI, according to Financial Times. 1/3 of financial services jobs could be displaced by automation by mid 2030. Who is saying this? PwC, one of the big fours, Power Waterhouse Coopers. LLP means limited liability partnership. Anyways, that's other stuff. Bloomberg says this. And Gartner says that leading organizations expect to double the number of artificial intelligence projects within the next 1 year. Wow, right? Though that's 2020 data, that's an interesting insight to look at. Financial analytics market by 2023 would have reached $11.57 billion. That's huge. And demand for AI talent has doubled in the last 2 years. Who is saying this? Adobe. So these are a few things that should certainly motivate you all in pursuing this financial analytics. Now, I'll talk about a few of the applications of financial analytics. Before we talk about that, I also want to take you guys to our website and show this basically. So just a minute. Let me pull up. So, just allow me a quick minute. Make subtle changes. Wonderful. Okay. So I'll be sharing my screen now, and I'll just quickly show you on what are the small enhancements that we have done and how will this work. All right, friends. So this training, and every now and then we keep adding new things based on the industry, patterns and trends. And these are the various things that people will learn. One is Financial Analytics 101 for you to understand what are the various things that exist in financial industry. And you'll be understanding, various frameworks that exist. What do you mean by algorithm trading? Let me write it here. There is something called as algorithmic trading. Trading means you buy and sell stocks on stock market. That's trading. How do you make use of algorithms to do the trading? Right? And portfolio management. You have portfolio management. Portfolio means collection of assets. Collection of assets mean, say you have purchased stocks of Google. You have purchased certain stocks of Microsoft. certain stocks of HSBC bank, right? So all those are called as assets. Individually, they are called as assets. Collection of all those assets is called as portfolio. Usually people who invest in stock market do not invest in a single company. They invest in multiple companies, and that turns out to be an amazing risk reduction strategy or risk mitigation strategy. So that's one thing that you'll learn about. You'll also learn about robo advisors. Who are robo advisors? So if I am given an option to manually handle stock market, how would it be? You'll have some, if you take S&P 500, you take S&P 500. In S&P 500, which is Standard and Poor's 500 index, 500 of the largest companies that will be listed. And that's huge, isn't it? 500 companies, right? And where are the list of companies here? All of these. You have Adobe, you have Accenture, right? You have various companies. You'll have, you name it, you'll have American Airlines Group, so on and so forth. If I ask you to manually keep a track or learn the patterns and keep buying, selling the stocks, if I were to ask you to manually buy or sell or hold on to the stocks that you purchase, don't do anything. With the objective that you have to maximize return on investment. You would have invested, say, $100. Maximize the amount that you get. With this objective, if I ask you to buy, sell, or hold the stocks continuously every second throughout, right, until you want to be in the stock market, it's not possible at all. 500 different companies, 500 different patterns, 500 different trends. Sometimes suddenly one of the stock would have gone up, so you might want to sell it. Suddenly some stock might fall, you might want to buy it at a lower cost. Who knows? I mean, what strategies are going to maximize the return on investment? What if all these things are taken care? What if all these things can be done by your algorithm? Wow, isn't it? And that is exactly what robo advisor is. 80% plus of the US market has moved towards robo advisory services, wherein a robot in the sense artificial intelligence robot, would actually help you do all these things. Then you have fraud detection. When it's financial analytics, a lot of fraud happens. How do you detect the fraud? Fraud detection usually falls in the ambit of anomaly detection. How do you detect that? Right? Loans, credit cards, okay, default prediction models, insurance. Who is going to claim insurance? Who is not going to claim insurance? Right? That's called as insurance. These things you are going to learn. Then you'll understand about what happened. Okay. Then you have automation and chatbots. What is the role of a chatbot? I mean, we have done a proof of concept for a Vietnamese bank. Okay, and then there was another project in the space of chatbot. Just a minute, sorry. It's not needed. Financial background is not needed, but you certainly need to have knowledge about data science. If you don't have knowledge about data science, this entire session might at the end of the day become irrelevant. So for those of you who don't know anything about data science, might want to probably drop off. This is not for y'all. This is for those people who are already working as data scientists or who got trained on data science concepts and AI concepts. Only then you will understand and appreciate the applications of those techniques in the field of financial services insurance. Of course, the domain knowledge which is needed, you might need some domain knowledge. You might want to accrue some knowledge on financial analytics. That is something that you will learn as part of the use cases that exist as part, in the training, obviously. Then you have something called as risk management. Today, I'll hopefully towards the fag end, try to touch upon risk management. And then you have asset price prediction. What should be the price of an asset? Asset can be gold, asset can be, um, commodity, not commodity. It could be some kind of derivative, or it could be anything, basically. It can be used for that case in derivative pricing also. Okay, sentiment analysis, trade settlement, money laundering. Oh my God, there are a bunch of things. Alongside that, of course, you'll understand various applications, which you'll understand as part of today's session. Some amount of data optimization and simulation knowledge is needed because we will be making use of techniques such as linear programming. Okay, you learn what is the risk in different curves? How do you make decision making under uncertainty? Right? Optimal portfolio allocation. What do you mean by capital allocation and calc? When do you use that? Then optimal risky portfolios. If I have two risky assets, how do I deal with it? What do you mean by mean, variance, efficient frontier? What do you mean by tangency portfolio? What do you mean by CAPM, capital allocation pricing model? CAPM is extremely famous, at least for the sake of its familiarity purpose, you should be knowing that. Then Black-Scholes and Monte Carlo pricing model, which is extremely famous in European market, etc. You learn that. And finally, you learn stock market movement, detecting financial fraud, personal loan detection prediction model, credit card prediction model, so on and so forth. Right? I'll speak more about the applications. I think today, major time we'll be spending on that. And then a few of the neural network and deep learning techniques is what you learn. Finally, we'll wind it up by understanding what are the various regulatory bodies and data privacy norms which exist in the space of financial services insurance. So let me once again tell you that you'll be given recorded videos if you enroll for the program, plus a few hours of training on the delta concepts, meaning we once in every 3 to 6 months bring in the new state-of-the-art algorithms which are relevant for that 3 to 6 months, which have emerged most recently. So those delta would be added. Those will be live instructor-led. Rest all would be pre-recorded videos. Okay. Having said that, let us understand about a few of the applications. So friends, you will understand a few of the supervised learning use cases. Let me write it here. Supervised learning use cases. Such as, obviously, the one thing which comes to most of your mind would be stock market prediction, stock price prediction. Let me tell you that stock price prediction is something which is next to impossible. But there are a lot of people who have won Nobel Prize in this kind of prediction space. It's not foolproof, but given the volatility in the stock market, this is the best that one can do. Second use case will be derivative pricing. How do you use your machine learning to do derivative pricing? Third thing will be investor risk tolerance. How do you predict the risk tolerance? Right? And a bunch of other things obviously will be there. Also, how to predict whether a specific transaction which a person is doing, say you're transferring some money to someone, how do I classify whether the transaction is safe or fraudulent? Transaction, is it fraud or not? Is something that you will be able to classify. Loan default prediction model is one of the most famous stuff which you learn anyways. Then we will also learn about Bitcoin. This is a new thing that we have brought in, because Bitcoin, a lot of people are talking about that. You will be able to predict whether to buy or sell in the Bitcoin. Bitcoin is basically virtual money that you're trading, right? When should you buy and when should you sell? What kind of models exist? We'll understand that. This is just a small bit of it. I'll get back to this and explain more. Then you have unsupervised learning. In the space of unsupervised learning, you learn about a few use cases such as portfolio management. In that, we will look at dimensionality reduction for asset allocation. Dimensionality reduction for asset allocation. There'll be a lot of assets. How do you deal with that? There are a lot of techniques such as PCA. You have SNE, TSNE, stochastic neighbor embedding, etc. There are a lot of things which exist. Some knowledge about dimensionality reduction will help. Then dimensionality reduction to generate something called as yield curve. Is also something that you learn. Then how do you enhance your Bitcoin trading strategy? Enhancing Bitcoin trading strategy. You'll understand that as well. Okay, and there are clustering techniques. Okay, majorly when it comes to unsupervised learning, two things come to your mind, right? Clustering, dimensionality reduction. And here you learn about how do I cluster. Clustering. You learn how to cluster in the space of pairs trading. There is something called as pairs trading. Then you'll understand how do you cluster grouping, or how do you group basically investors. Okay. And there is something called as risk parity. Risk parity. How do you look at this? Then there are two more broad things. One is reinforcement learning. Reinforcement learning. This is a new field which has emerged and it's doing very well. There are a lot of amazing use cases in this space. So how do you come up with reinforcement learning based trading strategy? This is one thing. Second thing is, how do you come up with reinforcement learning based hedging strategy? What do you mean by hedging, etc.? We'll learn. And reinforcement related based algorithms for portfolio allocation. Portfolio means collection of assets. Assets mean various, uh, you know, uh, various companies. You can think in that way. Then natural language processing warrants a separate discussion because NLP is becoming one of the amazing fields, right? And people who undergo our data science training will understand what they mean by NLTK, what do you mean by text blob, what do you mean by spacey, etc. You know, a lot of libraries. And here, how do you perform trading based on sentiment analysis? Is there a positive news going on in the news, or is there a negative, sentiment going on in the news? How do you create a custom chatbot? And how do you make use of that in the space of financial analytics, wherein you want your chatbot to assist you in making, informed decisions, in taking informed decisions? It is also used in document summarization. These are, a few of the very interesting use cases, but then we also have certain other amazing use cases. And we will be making use of deep learning to a very great extent. And you'll be learning a few of these are all applications. Basically, you can apply your machine learning and other techniques in financial services and insurance in all these areas. In deep learning, one of the amazing use cases which people are dealing with in the current world is called as index replication. And this is done using deep learning algorithm called as autoencoders. Okay, next. You can forecast the volatility. That's called as volatility forecasting. And this is done using something called as long short-term memory. This is another deep learning algorithm which exists. Okay, then you can take the news from the news articles and then you can apply NLP using something called as bidirectional LSTM and then determine the sentiments which exist. Based on those sentiments, you decide whether you want to invest in that particular asset, in that particular company stock, or maybe you don't want to invest. Right? That's a call that you take. Then you have a lot of risk in your stock market. You'll understand about that risk also. And then you will train trader robots, which will automatically trade for you using reinforcement learning. And there are a lot of additional things which we will learn eventually. Okay. And is this the complete list? Not really, but is this comprehensive list? Yes, sure. This is a comprehensive list of use cases when people want to work in the space of financial services insurance, in the space of analytics. Now, let me pull up a specific document and explain you some basics on financial analytics. So, just give me a bit while I pull up that. All right. Here we go. What do you mean by investment in the first place? Investment means, people usually work. I'm hoping so. People won't just sit and, consume government money. They work. So households, meaning people like you and me, we earn income through legal means. Typically, there are two ways we can do with our income. One is you consume the entire income. Say you are getting $10,000. You spend complete $10,000. So you're consuming. Or you save some amount and affirmatively invest it. Obviously, right? If you are saving some amount, you don't want to put it under your mattress. If you put it under your mattress, that money won't generate any additional money. So it becomes dead investment or dead money. Obviously, we don't want to do that, right? So, and also one more thing is, typically humans, they consume some amount and some amount they invest for emergency purposes. Why do you need to invest in the first place, right? Because we want to trade consumption intertemporally across periods, meaning maybe you want to save your money a bit and you want to invest it in once in 3 months for maybe an international travel, or maybe once in every 3 months you want to purchase some latest gadget, or for whatever purpose. You don't want to consume entire money here, and you want to consume that across various time periods. For that, you need to save, you need to invest. Saving does not mean take money and put it under your mattress. If you do that, it becomes useless, right? That money doesn't, you're not effectively using your money. And why invest? Because we earn a return on investment. You get some additional money as opposed to, you have $100. Say you spent $80, another $20. If you just save it in your, in your cupboard, then $20 will be $20. Even worse, it will depreciate in value because of inflation. Fuel prices increase, rental price increases, all the price increases, right? So you have to ensure that this money that you save somehow increases in value. So that's why you invest. A simple bottom line is you're saving an investment or investing because you want to postpone today's consumption to tomorrow. Today, you don't want to consume the entire money, you want to save it for tomorrow. And here are two examples. In one example, say you have $100. You have two investment opportunities. One is invest in something which will give you 10% rate of return. So your $100 will become $110 after maybe 1 month or 1 year, whatever is the time period for which you want to stay invested. And also there is another, let me call this as A. You're investing in some A. Another is some B. If you invest in that, you'll get 17% rate of return. So your $100 becomes $110. So this is you'll stay invested for 1 month. This also you'll stay invested for 1 month. In 1 month you get 17% return. In which asset do you want to invest, friends? Do you want to invest in A or do you want to invest in B? Where do you want to typically invest? Yeah, let's see. Okay, a few of y'all are saying you need to invest. Oh, everyone is saying invest in B. Okay. Now, do you know what you guys have forgotten? You guys have forgotten to analyze something called as risk. Suppose I say that this 10% return on investment is related to you investing in a government bond or a T-bill. We call government bonds as T-bill. Both are for same duration. You are staying invested for same duration. And say B is investing, going and investing in some gambling or going and playing gambling. If you gamble, you'll get 17%. If you invest in government bond, you get 10%. On an average, these rate of returns are called as on an average rate of returns. So here on an average, you get 10%. Here on an average, you get 17%. On an average, that means you can lose also. Where would you invest now? Now that I've given you, in some sense, the risk associated with these two, A and B. Where do you want to invest? You want to invest in T-bill, obviously, government bond, right? So you always have to look at the risk involved, right? So that's called as trade-off between risk and return. You consider the investment choice, which is facing an investor. Say one of the investor has $10,000 and a person is willing to invest $10,000. Say there are two choices that this person has. One is a risk-free investment where there is absolutely no risk. If you invest $100,000, you get $105,000 in one period. One period means it could be 1 month or 1 year or whatever, be that one period. Okay, and then choice two. This is a risky investment. There is 60% probability that you get $150,000 if you invest, or there is 40% probability that you'll get 80,000. So there's 40% probability that you will lose $20,000. There is 60% probability that you'll gain $50,000. Given this, where do you want to invest? Yeah, I mean, if I just were to ask that statement, what would your answer be? Okay, a few of you are saying two, a few of you are saying choice one, but let's calculate and understand. Here is where your analytics comes into picture. Just a minute. So risk-free rate, this one, choice one. This is how you calculate. If you're investing 10,000 or 100,000, and if you're going to get $105,000, this is the start and this is the ending one. To understand what is the return, how much money are you getting, what is the return in percentage, you calculate this in this way. Here is the formula: end value minus start value divided by start value, obviously into 100, will give you the return on investment in percentage terms. So that's what is given here, right? End minus start divided by this. I mean, this they just divided this part here in this formula as end divided by start minus start divided by start. Start divided by start would obviously be 1. So it'll be end by start minus 1 into 100. Okay, next. If you look at the second choice, the calculation includes some rigmarole. Small amount of rigmarole is involved. This becomes end by start minus 1 into 100. Okay. So if you look at this, a risky investment will grow to $150,000. What does that mean? That means the start is 100,000. This is the same formula if we were to apply. Sorry, the end is $150,000. So end divided by start is 100,000 minus 1. If you solve it and multiply it with 100, you get 50%. That's the money that you get if you get 150,000. But if you get 80,000, then again, end is 80,000, start is 100,000. So end by start will be 80,000 by 100,000 minus 1. Obviously, you multiply it with 100 if you want it in percentage terms. Here there is 60% probability. So it's 0.6 into 50% plus 0.4 into minus 20%. When you solve it, you get 22%. So overall, if you invest in risk-free investment, you get 5%. If you invest in risky investment, you get 22%. Now, where do I invest? Is a call that you have to take. Okay, but we are not there yet. Okay, we are not there yet. There are many other things before we decide on where you need to invest. Okay, here we just looked at return on investment or expected return. And here is where people who have joined a data science training, you are aware of something called as expected value or mean. Right on the initial days, first day or second day, maybe you would have learned about expected value or mean, which is given as summation of I equal to 1 until n xi into probability of xi. Wherever there is a chance associated, wherever there is a probability associated, you bring in this expected value or mean formula. Wherever there is no chance or probability involved, for example, in risk-free investment, there is no chance or probability involved. In these kind of scenarios, you proceed further with your regular mean formula, which is summation of all the values divided by total number of values. So that's why I say that, having knowledge of data science will help you understand these concepts well, because here you just need to focus on the domain aspect of it. This, I believe you understood on how to calculate the return on investment. Here it is risk-free. That means there is no risk. 100% you'll get 5% return on investment. For sure you'll get it. That's choice one. Choice two would certainly, it has probability or chance. So expected return would be 22%. So 5%, 22%. Next. You also need to look at variance of a risky asset. Variance is in some sense going to capture the risk or uncertainty. If I were to ask you on what will be the variance or uncertainty when it comes to the first choice. First choice is what? Risk-free asset, right? There is no risk at all. And here, 5% is a return on investment. If you look at this, 5% is a return on investment on choice one, which is risk-free. And choice two, which is risky investment. Let me write it down here. Choice two is a risky investment. Here, you have expected return of 22%. That's the return that you can expect. 22% when it comes to choice two, which is a risky investment. Okay. Given this, what do you think will be this is the expected return. This is for 22%. This is, you will anyways get that return on an average. Now, if I were to ask you about risk, what is your take? What will be the risk for choice one, friends? What will be the risk for choice one? Anyone who can let me know on what will be the risk associated with this choice one? What will be the variance? 0%, absolutely. There won't be any risk, my dear friends, because it's a risk-free asset. If there is no risk, variance will be 0. Variance is a proxy to uncertainty or risk. And the formula for variance is given in this way. It is summation of I equal to 1 until n xi minus mu whole square into probability of xi. This is variance when there is probability. Otherwise, what is a typical variance formula? Summation of I equal to 1 until n, if it's small n, xi minus mu whole square divided by n minus 1. For sample, this is the formula. Simple, we will not be getting into too complicated stuff, right? For mean, formula was summation of I equal to 1 until n xi divided by n. But for expected mean, formula was summation of I equal to 1 until n xi into probability of xi. This is expected mean, expected variance, regular variance, and mean. You use these two formulae when there is certainty, when there is no chance. You use these two when there is no certainty. When there is some probability involved in the values. Here, when there is Nothing to do with probability. When the values are very certain, you go with this formula. Okay. So if I apply this variance formula here, it is 0.6 into 0.5 minus 0.22 whole square plus 0.4, 40% probability into minus 0.2 minus 0.22 whole square. This is xi. This is mu. Mu is this. Point 0.6, 0.4 and the other values are coming from here. So here, if you look at this, 0.6 is a probability, 0.4 is a probability. If you get 150,000, return on investment is 50%. Here the return on investment is minus 20% because you can get also 80,000. So you lose 20%. And that's what is given. And from that, if you want standard deviation, you take a square root of that because standard deviation is nothing but square root of variance. This is also another formula that you're aware of. Look at the basic formula that exists. And the basic formula is what we are looking at to arrive at the decision making. So here is a quick comparison. Choice 2 has an expected return. If you were to look at this, I'll erase these. If you look at choice 2, it has an expected return of which is 17% more than risk-free. If you look at these values here, risky asset is giving you 22%. Risk-free is giving you 5%. Will give you, if I take out this 5%, risky will give you 17% more than risk-free because risk-free is already giving you 5%. Plus whatever is left out, that's what is going to be your risky. So it will give you 17% more than the standard deviation or risk of so much. Now the question is, would you be willing to take 34.29% risk for this extra 17%? Okay, this question we will address tomorrow when we connect at the same time. Please join at the same time tomorrow and we will have the session for another hour. Okay, thank you all so much. And we shall discuss tomorrow and continue this discussion. Thank you. Have a good day. Good evening.